Hey, this is Sasha, and welcome to another episode on Let's Talk Stocks. And today what we're going to cover is the two main ways that you can pick winning stocks based on the return. We're going to cover three main points here. We're going to cover those two main ways. We're going to cover how do they fit in your portfolio. And number three, we're going to go ahead and look at how you find these kinds of things. How do you find these winning stocks? So let's get started and let's go to the paper this time. So I'm going to let you in on a little secret. It's not that difficult to understand this video on your two main ways that you could go ahead and profit based on return. So this is our point number one. And this is the two winning. I'm just going to do it based on returns. Okay, so returns. So the first one, it's based on, let's just say, huge returns. And the next one, you're going to probably think it's small returns. Not really, but you could say yes. It's really about consistency. Okay, so consistency has smaller returns. So what's the pros and cons? I think you can figure it out. This is probably due for a whole different video if we were to do the pros and cons. But really with huge returns, you have higher risk here. This is lower risk. If you're getting consistency, there's still risk, it's just lower. Returns are smaller returns. This is higher, of course, returns. So these are more like speculative plays. This is more safer plays. Think of this as dividends. Think of this as more like could be penny stocks, could be day trading, that kind of thing. Okay, so when you look at this, this is kind of the two main ways that you're going to have winning successful trades based on their returns. So you either have huge returns or you have smaller returns. Huge returns are higher risk, they're speculative. Smaller returns, you're looking for more consistency. So this is going to be all over the map. Sometimes you'll hit or miss, and this is going to be more consistent. So when you're looking at this, you have these two main ways of winning stocks. One's going to be, hey, more speculative, higher risk. The others are more consistent, but smaller returns. So the question is now, where in the world do they fit in your portfolio? So our point number two right here is, where do they fit in your portfolio? Okay, so that's, I guess, the big question. And I always like to draw a portfolio diagram actually more like a triangle. That's just my way of approaching it. And if you break it down into thirds, this is about 50%. This, you could say, is about 25%, and this is the remaining. And this is, of course, based on capital. All right. So if you have, let's just say we have $10,000. You could say that, hey, this right here, this is $5,000. You could say this might be $2,000. This might be $1,000, and you might have $1,000 holding back for cash or that kind of thing. So again, so where do all these things fit in? Well, this is your speculative play. This could be, again, like your penny stocks. This is where you're going to get your huge returns. This is where you're going to get your consistent, right? This is your safe investments. This is your dividends. Now in here in the middle, this could be your swing trading or 30 to 60 day option trades. So that's a little bit more in the middle. It's more somewhat safe, but not super safe, and it's somewhat risky, but not super risky. So it's right in between there. So this is how you would kind of break it down, and this is where it goes in your portfolio. Okay, so as we look further and we look to how in the world do we find these kinds of things, well, let me share with you a little bit of insight here by the charts and how to do some scans for this. So let's go kind of to the screen here, and you might be wondering, okay, so how do I find these things? Well, probably the first thing, if you're looking at, let's say, US common stocks or S&P 500, if you look at the volume usually just the ones that are traded the most. It's not always going to be this way, but these are the very popular ones. And then what you're going to do is narrow down to, hey, the safe plays are the ones that usually have produced a lot of good dividends over the years. So AMD is not one of those cases, but as you start scrolling, things like maybe Bank of America, GE, again, there's a lot of volume traded there, but the stock has been toast and it's going down for quite a while. So it's not one that's a safe play. You'll probably know and understand these stocks when you see them. So for example, maybe things like an Apple, traded, highly traded volume, and a dividend is there. You might also look at things like, let's say, a Microsoft. Here's a Microsoft. And you can see I've skipped a lot. Why did I skip Ford? Well, because it's a car company and continues to go down, and these things have not been growing, and the dividend's not that great. So instead, things like a Microsoft that has been growing. So you start looking and through these things and you say, hey, okay, well, which ones are growing? Which ones are on the S&P 500? Which ones are safe? And then now, as I pick my list, okay, so let's say Johnson & Johnson got a dividend, ExxonMobil, Coca-Cola, maybe JP Morgan. So I take those, Nike, you think of these companies, which ones are big? Starbucks. And now what you do, okay, so I take these few companies, I go ahead and pop up my browser. So I'll go ahead and open up an Opera browser right here. And now I can say, okay, well, let's take one of these stocks that we had. Let's say Starbucks, Starbucks dividend history, and you check it out. So out of your list of 5 or 10 that you've looked at, you can take a look at the dividend history and you can say, hey, this dividend actually seems pretty stable. It's been going back to about 2010 and it continues to increase and improve in 2019. So it looks good, right? So that's what you're looking for, like a long 10-year history. You could look at other websites here again, dividend growth over the last 8 years. So something with a long dated history, good dividend, that's kind of what you're looking for on an investment, even maybe a swing trade as well for multiple months. But you can get those ideas fairly easily. If you're looking for speculative plays, this is where it becomes more difficult. So for huge returns, you'll probably do a scan that's more like, and let's just kind of create an easy scan. And if we're looking for US common stocks, that's the ones we're looking for. I have a lot of different scans already set up just from doing different videos, but let's say we got a new condition. I'll probably do a price that's greater than, and probably a price greater than, let's say, $15. So now I could go ahead and start that scan, but I probably want to go ahead and, well, let's just start the scan. So now you can go ahead and see all of these companies, but there's like 2,700 of these. So let me just start with the price right here. And you can see some of these are just wacky. And that's because the volume is very weak. They're not really trade a lot. Could you go ahead and try some of these for speculative plays? Absolutely. But you really never know what you're going to get. So here you might get some that are toast, some that are just not moving at all. And a lot of this is because of the volume. So what I would typically do is add to this condition, okay, also a volume, maybe something that's greater than, or you could say ranks, something, just cut out the bottom junk. And all of a sudden, you go from that to a little bit less. I might need to go ahead and adjust this even more. Let's say ranks in the top volume segment. Let's just see what kind of scan we have. So there we go. Now we're down to 1,000. But you can see volume here is about 117,000. This one's got 2.6 million, 100,000. I would say anything above about 100, 200,000 is a little bit better. So I could do is greater than, and right now the trading day is not over, but let's say 200,000. Better put enough zeros. I wish they added commas here. 1, 2, 3. Okay, and now let's see where that gets us 650 on the list. So yes, this is a tedious process. You start looking at things, but at least the volume is somewhat there. And now you get some insight on stocks. Hey, this could be, and I'm not recommending this one, but let's just say, hey, I want to play this off the support. If that's what you want to do, then that's kind of what you're watching for and looking out for. So you start scanning some of these things, and any charts that maybe catch your eye, you could go ahead and research these companies as well if you want. And then go ahead and make a decision. So that's how you would go ahead and look for maybe potential huge returns, watching for stocks that are potentially at support levels or near resistance levels that could be breaking out. And as you start spotting those things, those are the ones that could give you some opportunity. But again, these things usually are short flyers. Sometimes, you get some new ones, like let's say there's an IPO, and I don't know which ones are new, but here, let's say this one, kind of a newer one from 2008, or let's say this one, also newer one, but you can see it's toast. Here's another one. Oh, here you go. So this one was a newer one in 2006, and you can see here we had some explosion and did pretty well. Now it's at the $15. Is it possible it could do it again? Maybe, but that's kind of what you're looking for. Hey, it's kind of a new company, and then at the beginning that would have been your entry point somewhere around here, and then you sell it after a year or two. So you could look for newer companies like that, or here's another one. Newer company, there was a little digestion, boom, explosion. That's another way of doing it. So anyways, I hope this gives you some insight and things to think about regarding these companies, because there's so many different ways to go ahead and find them, search for them. But really, when you're looking at creating returns based on the movements of these stocks, there's really just those two ways. You're going to have huge returns, or you're going to have small returns. Huge returns, you're going to be all over the place. Small returns, well, you'll probably get more consistency. So where does that fit in? Well, break it down in your portfolio, and you might have a few plays that are speculative that will give you huge returns, and then you'll have a few plays that are not going to give you huge returns, but they'll be consistent for you. And together, that should work out fairly well overall for the totality of your money. So anyways, thank you so much for joining me. I hope you enjoyed this video and you got a little bit out of it. And if you did and you want to stay subscribed on the YouTube channel, go ahead, hit the face, and then you'll stay subscribed on YouTube. Or otherwise, go ahead and join me on my newsletter list, so that way you get notified as I release new courses, books, and other great training material. Thanks again for sticking with me, and remember, do what you love, contribute to other people, but most importantly, live life abundantly. I'll see you next time.